Welcome back to the deep dive. Our mission here is to take the densest sources, the most complex research, and just transform it all into crystal clear, actionable intelligence.
And today, we're cracking the code on a big one, financial statement analysis.
We are. And we're starting right where most people, myself included, get tripped up. It's this problem of meaningless magnitude.
Exactly, the illusion of the big number. I mean, think about a huge corporation. Let's use DuPont as an example. You look at their statements and you see, okay, $2.8 billion in net income.
And my brain immediately just goes, wow, billions, they're successful.
Right. And they have, say, almost $50 billion in total assets.
But that immediate reaction is just, it's useless, isn't it? Because those numbers don't exist in a vacuum. I mean, $2.8 billion in profit might be incredible for one company, but maybe a total disaster for another.
That's it. That's the whole game right there. The central question we're trying to answer is just, is that good?
Is it good?
Precisely. Raw numbers are just static facts. They lack context. You can't tell a story with a single data point. So our mission today is to show you how financial ratios solve that exact problem.
They analyze the relationships between the numbers.
Yes, they take those static figures and turn them into dynamic, actionable intelligence. It's all about the relationships.
In this analysis, it has this kind of dual function, right? It's not just looking backwards.
Not at all. We use these ratios for two main purposes. First is diagnosis. That's the backward-looking part.
Yeah.
So if we see a ratio like, say, return on sales suddenly drop, it immediately flags a problem. It's a symptom.
It doesn't tell you the cause, but it tells you exactly where to look for the disease.
Exactly. It focuses your energy.
Yeah.
And the second purpose is prognosis. This is the forward-looking aspect. This is what investors and creditors really care about.
This is about prediction.
It is. A company that consistently shows a high, stable return on assets is just a much safer bet for the future. So the ratios inform your confidence.
Okay, so let's unpack this. To use the tools, the ratios, we have to understand the raw materials, the foundational documents. And that starts with a really key distinction in the world of accounting.
Right. It all comes down to who is using the information and why. So on one side, you have managerial accounting.
This is for the insiders.
Yes, this is used to run the business. Internal decisions. You know, should we authorize overtime on this production line? Is this product actually profitable? It's detailed, it's proprietary.
And on the other side, financial accounting. This is for the outsiders. Standardize, used to report on the business.
And that standardization is vital. External users, investors, creditors, they rely almost completely on it. They need to be able to compare Apple to Microsoft, you know?
Or DuPont to Dow Chemical.
Exactly. They use ratios to assess risk if you're a creditor, or to assess return potential if you're an investor.
But the managers, the people actually running the company, they live in both worlds. They're using that granular, messy internal data every day, but they also have to package it all up for the outside world using what our sources call the three pillars.
The three pillars, let's define those because the timing is everything. It's the critical difference.
Okay.
First up, the balance sheet. And think of this like a photo, a snapshot.
A single point in time.
A single specific point in time. Close of business December 31st. It freezes the company's assets, liabilities, and equity.
Then you've got the income statement. This isn't a snapshot, it's more like a movie clip.
That's a great way to put it. It shows profitability, revenues minus expenses, but over a period of time, a quarter, a year. It tells you what happened between two of those balance sheet snapshots.
Got it.
And finally, the statement of cash flows. Also covers a period of time, and this might be the most important reality check of them all.
Why is that?
Because the income statement uses what's called accrual accounting. It records a sale when you send the bill, not necessarily when you get the cash.
Ah, so you can look profitable, but have no money in the bank.
You can. The cash flow statement tracks the actual physical movement of cash. Operating, investing, financing. It tells you the true quality of the earnings you see on the income statement.
Okay, so we've got the ingredients, the three statements, and we know the raw numbers are meaningless. Now let's get to the tools, the ratios. This is where it goes from just accounting to actual business intelligence.
Exactly. The ratio is the universal interpreter. Let's take a simple one. Return on sales, or ROS, sometimes called net profit margin.
That's just net income divided by sales, right?
Yep. So if a supermarket has $10 million in sales, that sounds great. But if their net income is only, say, $100,000, well, their ROS is 1%.
1%. So for every dollar of stuff they sell, they only keep one single penny.
Right. And knowing that, it changes your entire understanding of their business. They have to live on massive volume and super tight cost control. And if their competitor is keeping 5 cents on the dollar,
then that 1 cent company is at a huge disadvantage, even if they both have billions in revenue. It gives you immediate context.
Okay, so let's take that power and apply it back to those big, scary DuPont numbers we started with. Let's systematically answer the 3 big questions a decision maker should ask.
All right, question 1. Is that $2.813 billion in net income actually large?
To answer that, you have to compare it to the investment needed to make it. So we use return on assets, ROA.
Net income divided by total assets.
Correct. So $2.813 billion in income divided by that $49.736 billion in assets, that gives us an ROA of 5.66%.
Okay, 5.66%. That number I can use. So for every $100 in assets they control, DuPont is earning $5.66.
Exactly. Now you can compare it. If the industry average is, say, 8%, we immediately know DuPont is underperforming its peers at turning assets into profit. The billions just fade away. The efficiency is what matters.
All right, that makes sense. Let's move to question 2. Is that massive $49.736 billion in assets just right? How do we know if they're even using all that stuff effectively?
This is purely an efficiency question. And the tool for that is asset turnover. That's sales divided by total assets.
Okay.
So if we assume DuPont sales were around $35 billion, their turnover is about 0.70.
A turnover of 0.70? What does that actually mean?
It means for every dollar they have tied up in assets, factories, equipment, inventory, they are only generating 70 cents in sales revenue that year.
I see. So if that number is low, or if it's dropping year after year, it's a huge red flag. It could mean they have expensive machines just sitting idle.
That's a classic example. They're not sweating the assets, as they say. The efficiency is poor, and that drags down the overall return.
Right, and that brings us to the third, and maybe the most critical question, especially for anyone lending the money, is $39.557 billion in liabilities.
Yeah.
Is that too much debt?
This is where financial risk really comes into focus. It's a huge number.
So to get context, we need to compare that debt to the buffer, to the skin of the game from the owners, their equity.
Correct. So assets minus liabilities gives us equity. That's about $10.179 billion. Now for the ratio, the debt to equity ratio, liabilities divided by equity.
So $39.557 billion divided by $10.179 billion. Wow, that's 3.89.
3.89.
Wait, so for every $1 of the owner's money in the business, the company's using almost $4 of debt. That feels incredibly high.
It is extremely high. That's what we call high leverage. And the insight here is pretty stark. This dramatically increases the company's risk profile.
I can see why. If there's a recession and their sales dip even a little, those huge interest payments on nearly $40 billion of debt don't go away.
They don't. And that could threaten the company's solvency very, very quickly. So if you're a bank, you see a company with just moderate returns at 5.66% ROA, but this enormous risk exposure from a 3.89 debt to equity.
You're going to charge them a much higher interest rate to compensate for that risk.
Yeah.
The raw numbers just say billions, but the ratios tell me they're walking a tightrope.
You've got it. We've just transformed 3 meaningless numbers into a real story. A highly leveraged company with moderate returns. It's powerful.
It is. But as you said, we can't just look at that 5.66% ROA in isolation. To get the full picture, you need to put it into a kind of a 3-dimensional context. What are those 3 dimensions?
The first is trend analysis. Simple enough. You have to compare that 5.66% against DuPont's own past performance. Is it going up or down over the last 5 years?
So are they getting better or worse?
Right. A low number that's rapidly improving is way more attractive than a high number that's shrinking. The second dimension is cross-sectional analysis.
Comparing them to their competitors.
To their peers.
Yeah.
If Dow Chemical is running at 8% ROA and DuPont is at 5.66%, we immediately see a competitive disadvantage that we have to understand.
Okay. Trending competitors. What's a third?
Third is expectations analysis, and this one's often missed. How does that number stack up against their own forecasts or what we expect from the future economic environment?
So what they said they were going to do.
Exactly. If management only forecasts 3% growth when the whole industry is expected to grow 10%, that's a bigger red flag than any historical number.
And when you combine all 3 of these, you start to need a system, a framework to tie it all together. Which brings us, appropriately enough, to the DuPont Framework.
Yes, the framework itself. It has this fascinating history. It was developed by F. Donaldson Brown at DuPont way back in the early 20th century.
What was the problem he was trying to solve?
He needed a consistent way to compare totally different investment ideas, like what's a better use of our capital?
Yeah.
Upgrading a factory or buying one of our suppliers? He needed one system to evaluate both.
And that system became this breakdown of return on equity, or ROE. The ultimate measure for shareholders.
It is. The genius of the formula is how it splits ROE into its three core drivers. It shows that ROE is a product of three things.
Okay, what are they?
Profitability, which is net income over sales, multiplied by efficiency, which is sales over assets, multiplied by leverage, which is assets over equity.
Profitability times efficiency times leverage. So if an investor sees ROE go down, they don't just know that it went down, they know why.
Precisely. If profitability is down, you have a margin problem. If efficiency is down, you're not using your assets well. If leverage is off, you have a capital structure problem. It points you right to the source.
It's like a GPS for management.
It is. And beyond that main framework, our sources point to a couple of other really useful tools for context. The first is common-size statements.
What are those?
They're a brilliant way to normalize data. Instead of looking at dollars, you just express every line on the income statement as a percentage of sales, and every line on the balance sheet as a percentage of total assets.
So you completely wipe away the size difference. You can compare a huge company to a tiny startup.
You can. A big car company might spend $5 billion on R&D, but that's only 2% of their sales. An EV startup might spend only $500 million, but that's 15% of their sales.
The common size statement immediately shows you the startup is way more aggressive on innovation. It tells you about strategy, not just size.
Exactly. And the other tool is about that reality check we mentioned, cash flow ratios.
Right, because of that accrual accounting issue. You need to make sure the cash is actually there.
You do. A classic red flag is when you compare operating cash flow to net income. If you see high net income, but really low or even negative operating cash flow,
Houston, we have a problem.
you have a big problem. It signals low quality earnings. The company is profitable on paper, but they aren't generating the cash they need to pay their bills or invest. It's an essential check.
This has been a fantastic tour of translating accounting into intelligence. But before we wrap, we have to touch on the cautions. I mean, these ratios are powerful, but they're not foolproof.
No, not at all. There are three big limitations to keep in mind. The first is non-comparability.
Even within the same industry.
Even then, companies use slightly different accounting methods for things like inventory or depreciation, so you're almost never comparing perfect apples to apples.
Okay, what's second?
The information is incomplete. The financial statements don't quantify some of the most valuable assets a company has today. Think about brand value, or proprietary software, or just the talent of your people. They're not on the balance sheet.
That's a huge blind spot.
It is. And finally, there's the most philosophical challenge, the historical focus. All of this analysis is about the past, and focusing only on past trends can make you blind to what's happening right now. A key executive just quit. A major lawsuit was just filed. That stuff isn't in last year's numbers.
It's that constant tension, using the past as a guide without becoming a prisoner to it.
Well said.
Well, the core insight here really is that financial statement analysis is the bridge. It's what transforms those huge abstract accounting numbers into practical, actionable intelligence. It replaces guessing with informed decisions.
And for you, the listener, this framework is just a core piece of business literacy. I mean, whether you're evaluating a potential employer for its stability or managing your own investments, these tools let you see the real health of any organization. You stop just reading the numbers and you start reading the story.
So if you take one thought away from this deep dive, it's to stop asking, how much money did they make?
Instead, use the frameworks we talked about. Connect profitability, efficiency, and leverage, and ask the ultimate question. Based on these numbers, is this a healthy, efficient, and profitable company? And what specific driver is responsible for that result? Finding the why is what it's all about.
That's your challenge. We'll see you next time on The Deep Dive.